Well, first, I want to welcome everyone to Last Chance Comment on Proposed Federal CRA Rule Changes. As you noticed, we are recording this webinar so that we can put it up on our website and so others can view it as necessary. As I mentioned before, we've enabled live transcript. So if that's something that you need, you should be able to access it with the controls at the bottom of your screen. But if you're having any problems, please message Bibi and Christina and she'll help you. There will be time for questions. Please note them in the chat as we go along, but we'll also have time specifically at the end. Next slide, please. So joining me today in presenting on the Notice of Proposed Rulemaking is Horacio Mendez, President and CEO of the Woodstock Institute, Jane Doyle, Policy and Communications Associate with the Woodstock Institute, Tasha Brown, Midwest Director for the Small Business Majority, and I'm Sharon Lagenza. I'm the Executive Director of Housing Action Illinois. Next slide, please. So this just tells you a little bit about our organizations. And we're here as part of a broader coalition, which is the Illinois CRA Coalition. And we're a group of organizations dedicated to protecting and strengthening the federal and the new Illinois Community Reinvestment Acts. We want to build more equitable communities, and we want to make sure that the racial wealth gap is addressed through investments in low and moderate income communities, communities of color, and individual households. So next slide. So we're not going to go into CRA, the law itself. I mean, this is, I believe now, the fourth webinar over the last 3 or so years that we've brought regarding the Federal Community Reinvestment Act. And we also have brought one on the new state law. But just some basics, Community Reinvestment Act was passed in 1977 to incentivize or to make investments in low and moderate income communities a reality. It was a response to redlining, kind of the deliberate lack of loans or making credit available in communities of color in particular. So what the CRA is intended to do is to make wealth building more accessible for low and moderate income households by examining how banks are doing basic banking services in those areas, if they're providing responsible homeownership opportunities and capital for small businesses, if they're investing in the development of affordable housing, and if they're supporting neighborhood revitalization, stabilization, and other services. So there are 3 regulators who enforce the CRA: the Federal Deposit Insurance Corporation, the Federal Reserve Board, and the Office of the Comptroller of the Currency, OCC. So we're going to be usually terming these as the agencies or the regulators as we move forward. And you can find the prior webinars that I mentioned, as well as other information about the Federal Community Reinvestment Act on the coalition website, which is www.ilcracoalition.org. So I encourage you to go there if this, really, I wouldn't even call it an overview, but just kind of this basic introduction to CRA is something new, or if you want to learn more. Next slide, please. So I wanted to mention what we're terming like kind of this modernization of the CRA, the federal CRA. How we got here today is on May 5th, the 3 federal regulators released what's called a Notice of Proposed Rulemaking, or NPR. That's kind of the last step to adopting new rules that will govern how the CRA is implemented. The last major interagency revision was in 1995. So this is kind of a once-in-a-generation opportunity here that we have to influence the NPR, or how the rules are regulated, or how the law is regulated and implemented. And it was quite an ordeal in the sense of it's been a long time coming. I know that we have actively worked as a coalition for more than 3 years. And when I mentioned all the webinars we've brought, I just wanted to say kind of the backstory was that the OCC had proposed its own rules with the FDIC back in 2019, I believe. And then actually adopted that in their own rules in 2020, although the FDIC was not part of that. So we were doing comments on the OCC's proposed rules and then, when they were adopted, then the Federal Reserve Board issued its own advance notice of proposed rulemaking in 2021. And so there's been a lot of movement around this area and a lot of review. And that's why for this particular webinar, we wanted to focus on very quickly going into what's being proposed, because thankfully, something that we had suggested, as well as many other advocacy groups, is that the three regulators needed to come together and do a joint rule. And that's what we have here. So the OCC ended up rescinding its own rules in 2022. And so now we have all three groups coming together and issuing this joint notice of proposed rulemaking. The comment period ends on August 5th, so that's next Friday. So we're coming to the close of a very busy period. So I wanted to say, even though we're going very quickly through some of this initial stuff, there is a lot of information that's been out there, and we've been working on it for a number of years. So now I'm going to pass it on to Horacio to go into the NPR.
Thanks, Sharon. Good morning, everybody. I hope you guys are having a good Tuesday. So just to kind of give you an idea to the answer that the regulatory agencies gave to us in the advocacy world of, so what did you do this summer? I'm not sure if you guys can see the screen because we've got the presentation. This is the notice of proposed rulemaking. It's 700 pages long. So they dropped it on Cinco de Mayo when we were all having margaritas, and it gave us something to do while we were pretending to be on vacation and trying to understand this behemoth. Now, overall, it is divided up into a number of different sections. They add up to 11, but there are kind of some categories here. Obviously, the issues of assessment areas that we've talked about over the course of the years, how to define community and where to look at CRA information. Within that, within those communities, how you define what counts and what doesn't. And I think for the most part, we're going to go through an enhanced version of the definition of community development. There's not a whole lot new here, but there's greater clarity. So that way there's a list that people can check off. Tied to that is an evaluation framework that in some cases creates greater accountability and a higher bar for some financial institutions to try to achieve, but may also have some unintended consequences. Within that are the tests associated with that evaluation network. There's a retail lending test, and there are also a retail service and products test. Those are separated, but they're really focused on retail lending services and products, so we kind of clump them into one sort of category. Same thing with community development. There is one test that the agencies are proposing, which is something that we're kind of used to, that community development finance test. There used to be a separation of lending and investment. We saw through the advance notice of proposed rulemaking, they were thinking, well, what if we just clump them all together and just call it community development finance? Then separate of that is going to be a test that takes a look at services that fall under that kind of broadened definition of community development. There is a new idea called an impact review. We saw versions of this in the advance notice of proposed rulemaking. Kind of how do you get a smiley face on your paper? You know, what's kind of extra credit? What are things that enhance the weight of maybe a smaller deal, but it's really responsive, so maybe that should have additional weight. There's some proposal about how they might be able to incorporate that into their assessment. There's some conversation about how to grade, so the ratings matrix. In previous episodes of this ongoing drama, we've had a variety of conversations about the point systems in order to get satisfactory, outstanding, needs to approve, or substantial non-compliance ratings. There's a new sort of offering on the table. And then finally, there's quite a bit of new data that's being proposed to be collected, not from everybody though. So that's going to be something we're talking about, but this includes a focus on auto lending, which, okay, but also collecting some information about deposits. So that's also something we're going to be talking a little bit more about. Can we go to the next slide then? Great, thank you. So there are a number of goals that we've heard the agencies talk about over the course of the last few months with regard to what they want to get out of this. So first and foremost, they want to achieve, strengthen the achievement of the core purpose of the statute or the Community Reinvestment Act. Well, that's a bit of a blinding flash of the obvious, but we want to be able to make sure that that includes not only low and moderate income communities, but also communities of color. So there's that ever-present issue of race. They want the regulation to adapt to changes in the banking industry, including mobile banking and online banking. They want to give greater clarity and consistency in the application of the regulations. They'd like to tailor the performance and standards to account for differences in bank sizes, business models, and local conditions. They also want to tailor collection and reporting requirements, the data that they collect and take a look at and review, and also try to maximize how they can use existing data, stuff that's already out there that they may be able to use to try to figure out how a financial institution is performing. They like to promote transparency and public engagement, so that's always nice. And they want to confirm that CRA and fair lending responsibilities are mutually reinforcing. And finally, what Sharon had already mentioned was that they wanted to create a consistent regulatory approach among all three banking agencies. So it was nice for the OCC to hit reset and join the other two agencies. So now we have one proposal that we can work on. Next slide, please. So these are the 8 priority areas that, after a lot of discussion between Woodstock, Housing Action Illinois, as well as the Illinois CRA Coalition Steering Committee, we kind of boiled these down, all of these issues down into 8 priority areas that we wanted each of you to get a little bit more detail on, and that will inform and be the structure of the draft sign-on letter that you'll be getting in the near future here. Obviously, we want to get into how performance is going to be measured and then what data is going to be used in the evaluation process associated with it. We have a lot of skin in the game of how communities are defined and then what communities are included. And that includes issues of non-metropolitan, suburban, and rural communities. We want to have a greater say in the role of the CRA exam, meaning I'm not necessarily sure how many of you have ever been approached by an examination team about community contacts associated with what's going on locally, but it is few and far between, and we'd like to see that enhanced a little bit. Then there's the issue that the agencies have talked about with regard to what they call their regulatory burden budget. They sort of feel like, let's assume you're on a budget of $20 for the week. Well, they had a budget of how much regulatory burden they wanted to place on the industry as a result of this reform. And how do you balance that with the interests and the needs of communities? So we dig into that a little bit. We're going to touch on issues of economic development and small business. And last but certainly not least, the ever-present and constant refrain that race has everything to do with CRA, so why the hell isn't it included? Now, before we move on, I'd like to see whether or not there are folks maybe in the chat, if you guys have other priority areas you want to make sure we at least touch on before the end of this webinar. So if you do, please add that to the chat to everybody, and we will pay attention to that. So with that said, I'd like to hand things over to my partner in crime here at Woodstock Institute, Jane Doyle. Next slide, James.
All right, hello everyone, good morning. So I am going to give an overview of the evaluation process in this proposal for CRA exams. It's extremely complicated, so I've tried to boil it down and make it digestible for this webinar. So first, the agencies are proposing 4 tests that will be a part of CRA exams. First, there's the retail lending test, which is going to be a quantitative test that looks at how a bank's loans are distributed across borrowers and communities, geographies at different income levels. And the proposal says that banks can be evaluated on 6 different loan product types: closed-end mortgage, like home purchase or refinance; open-end mortgage, like home equity lines of credit; multifamily housing; small business, small farm, and automobile purchase. And I also wanted to mention that this test includes benchmarks to compare a bank's performance to other lenders operating in that market, including non-bank lenders like mortgage companies, and also a benchmark to compare a bank's performance to community benchmarks that kind of estimate the demand for loans and investment in that area. Next, the second test will be the retail products and services test, which is going to be more qualitative and will look at what the products and services that a bank offers and its delivery systems, its branching patterns, where they operate branches, and whether all of those things are responsive to community needs, particularly the needs of LMI communities. And I don't remember if we defined it earlier, but LMI is low and moderate income communities. The third test is community development financing and investments, which will examine what loans and investments a bank has made during its exam period in community development projects. Now, this one is kind of a blend of quantitative and qualitative, because unlike for the retail lending test, where there's a lot of very rich data out there about mortgage lending, and we'll have even more information about small business lending in the near future, there isn't as much existing data on community development financing. So they've kind of made that one a blend of quantitative and qualitative. And finally, the fourth test is the community development services test, which will be qualitative and will look at what community development services or volunteer activities a bank and its employees have provided or engaged in during their exam period. Next slide, please. And as Horacio mentioned earlier, the agencies wanted to tailor the exams to bank size. So banks of different sizes will get different combinations of those exams that I just listed. The agencies created 3, really kind of 4 categories for sizes of banks. First, large banks, which are all banks over $2 billion in assets, will get all 4 of those tests. Within the large banks, the kind of quasi 4th category is very large banks with assets over $10 billion. They will have the same as the rest of the large banks, but they'll have a few additional data reporting requirements. And on the retail products and services test, they'll also be evaluated on their digital delivery systems, online banking platforms, that sort of thing. So the second category then, second official category, is intermediate banks, which have assets between 600 million and up to $2 billion a year. And those banks, intermediate banks, will get the proposed retail lending test. And then for community development, they'll be evaluated by default under the current existing community development test that they've been evaluated under for years. Or they can opt in to be evaluated under the proposed community development lending and investment test. Small banks, similarly, small banks have assets under $600 million on this in the NPR, and they will be evaluated by default under the existing lending test that they've been evaluated under for years, or they can opt in to the proposed retail lending test. And if you go to the next slide, here's just kind of a visual representation of what I just went through. This is actually a screenshot from a webinar that the federal regulators did when they first released this proposal. If you're interested, you can find the full slide deck from their presentation on our coalition website, ilcracoalition.org. And another point that I wanted to mention here, since it's a little bit easier to see, the NPR actually proposes changing the thresholds for the bank size categories. So some banks under this proposal will be moving into a smaller category than they were previously examined under. And this chart makes it really easy to see how the exam requirements get lighter for the smaller bank categories. One of our coalition's main priorities that we're really emphasizing in our comment letter is that this CRA reform proposal cannot result in any bank having to do less CRA activity than they did before. For example, nationally, there are 201 banks that were large under previous exams, but now with the changed thresholds would be considered intermediate banks. And we're saying that they should still be evaluated on their branching patterns, which would, under the new proposal, would fall under retail services and products. If they were evaluated on before, we want them to continue to be evaluated under that. And nationally, there are also 767 banks that were previously intermediate banks, but would now be considered small banks. And we believe that if they previously had community development CRA obligations, they should continue to have community development CRA obligations. Next slide, please. And yes, okay. Sorry, got lost for a second. Now going into how banks' performance will be measured under those exams. There are 4 possible overall ratings for a bank's CRA exam result. The highest is outstanding, then satisfactory, then needs to improve, then the lowest is substantial non-compliance. Satisfactory and outstanding are considered the passing grades, and needs to improve and substantial non-compliance are considered the not passing grades. And then also some of the subtests are broken out into high satisfactory or low satisfactory within that. So there's a little bit more detail, and the agencies are proposing on publishing a lot of detail about a bank CRA exam in what they release to the public, which we were happy to see. The current CRA rules and exams have been plagued by rating inflation. In recent years, 98% of banks have passed their CRA exams with satisfactory or an outstanding rating. And now as community groups, I'm sure you are all in tune with community needs and what access to banking looks like in your community. Do you really think that 98% of banks in your community are doing a good or a great job of meeting community needs? Probably not. So we were happy to see that there are some pieces of this proposal that really try to tackle that rating inflation. For one, the metrics-based tests, especially the retail lending test, set really clear and consistent expectations. So all stakeholders know what to expect. Banks know what to expect. Community members know what to expect, and there will also be more consistently between who is conducting an exam, what banks will be measured on. But there are some things that just can't really be quantified in the same way, so there's still some qualitative elements to the CRA exam that will allow for examiner discretion, but limited, so there won't be quite as much rating inflation. The agencies also wanted to tackle the issue of loan churn. And I'll explain a little bit about what loan churn means. So in the past, a lender, bank or non-bank, originated a loan to an LMI borrower. If the lender was a bank, then that original origination would count towards their CRA activities on their CRA exam. The originator would then sell the loan to another bank so that they could free up some capital and originate more mortgages in the community. Then the bank who bought that loan would then a few years later sell it to another bank, and so on. And each buyer would have that loan count on their CRA exam. So the same loan would be considered in multiple CRA exams over the years without actually generating new investment in the community. So we were happy to see that the agencies want to prevent this practice. We're just proposing that they take it a step further. We suggest that they limit CRA exams to loans that a bank originates or purchases from the originator. So then that prevents that same loan counting many, many times over the years, and still incentivizes ongoing investment in the community. Sorry, excuse me. As I mentioned, we also want to ensure that the bank size category changes do not result in less CRA and community development activity in communities. And if you'll recall from the previous slide, the intermediate and small banks can be evaluated under the current exam processes by default, but large banks, or they can opt into the new ones. So that hodgepodge of old exam procedures and new exam procedures doesn't serve anybody well. And we propose that the agencies implement a transition plan to bring those small and intermediate banks up to the new exam process, so that you can really compare apples to apples on those CRA ratings. Next slide, please. And then finally, the last 2 points that I'll make on this measuring performance section relate to community development. The agencies are proposing to publish a community development activities list, which will give examples of the kinds of projects that would be considered in a CRA exam. We are saying that they should proceed with caution on this. Our concern is that banks will then limit their activities to just things that are explicitly on that list and ignore projects that might be more innovative, but more responsive to community needs, but aren't on that activities list. So we're recommending that the agencies really emphasize that this list is not exhaustive and banks should not limit their activities just based on that list. Similarly, the impact review that this proposal adds will add a layer to the community development exams to add consideration of community development activities and their impact on LMI communities specifically. Again, here we're saying proceed with caution. We're happy to see them really considering how innovative a project might be and how responsive it is to community needs, but the proposal just doesn't flesh this out enough yet. So we are saying that the agencies need to develop this proposal further, add more quantitative elements to create some consistency, and also give the impact review its own score in the exam process to make it really clear how the impact review is changing the overall CRA exam score. And with that, I will pass it on to Sharon to talk about our assessment areas.
Great. Thank you, Jane. And I'm noticing some comments like from Chris around community outreach, transparency, and easy access information. So we will be addressing that as we move forward, but thank you for putting that in there because those are concerns that we have as well and that we'll be expressing to the regulators about the NPR. But moving on, I want to just remind people, as Jane had said, that bank size matters. So when we talk about assessment areas, which is my topic, it's the three main categories of large banks, which is our assets of 2 billion or above, intermediate banks, assets between 600 million and less than 2 billion, and small banks, which are assets less than 600 million. Next slide, please. And so assessment area is important because as we talked about, it's really like kind of what are the communities that a bank has to serve for CRA purposes and where will that activity be credited? And there are 4 different levels or proposals in the NPR: facility-based assessment areas, retail lending assessment areas, other areas for eligible community development activity. And actually, this is not in the NPR, but it was earlier talked about in, I believe, the ANPR, but we want to support the creation of deposit-based assessment areas. And because we're housing people, we have to have acronyms. So you see all the acronyms there, if you want to use acronyms instead of the full name. So next slide, please. So facility-based assessment areas are really just the areas around where a bank has a physical presence, main office branches or deposit-taking remote service facilities. In other words, ATMs and similar type deposit-taking facilities. So in the NPR, it proposes that intermediate and small banks could designate partial MSAs or counties. Large banks have to designate whole MSAs, metropolitan statistical areas. And that's important because of the history of redlining and the history of carving out perhaps harder to serve areas or areas that are lower moderate income or communities of color. And so our position is that partial metropolitan statistical areas or counties are okay for smaller banks or small banks, but not for intermediate banks because they have a lot of assets. And they should serve full MSAs or counties to avoid redlining. And one of the things that the NPR says is that, facility-based assessment areas can't reflect illegal discrimination or arbitrarily exclude low and moderate income census tracts regardless. So what we think is, it's kind of that old saying of trust but verify. If they're going to allow intermediate banks to have partial MSAs, which again, we do not support, we want to make sure that the regulators adopt some sort of review process to make sure that LMI and predominantly or majority minority tracts are not excluded. Again, we feel that this is a great opportunity to address some of the historic failures. And so we want to just make sure that all communities are getting equally served. So then the next slide is already up, which is about retail lending assessment areas. And this is new in the NPR, and it's proposed only for large banks. And what this is it would create assessment areas where there are concentrations of home mortgage or small business lending outside of the facility-based assessment areas. And how the NPR defines concentration is by just a numerical threshold, 100 home loans or 250 small business loans in each of the 2 most recent years. That's how they would define it. So what we think, our position is that creating retail lending assessment areas is a great idea because we want to cover where banks are actually doing business. But we would like to also include intermediate banks in the requirement for retail lending assessment areas and add consumer lending activity to this. We also do have a caution, though, which is that if there's a flat numerical threshold, we want to make sure that banks, for example, don't do 90 home loans in a year and then decide we're not going to go further because we don't want to trigger this retail lending assessment area requirement. So this would be something that we would want to have the agencies monitor to make sure that there isn't any manipulation of that process. So if I can go to the next slide, please. Then there's this other one, which is called Other Areas for Eligible Community Development Activity, and it's new. And this is really around where community development loans, investment, and services can be conducted kind of nationwide, maybe at an entire state level, multi-state, or kind of the bank institutional level. And they would allow banks to be evaluated under the performance test that Jane just discussed. So we think that, it's one of those things where we want to be supportive of, again, including areas where banks are doing business and to incentivize banks to do business in areas, particularly where there are low levels of community development. But we want to proceed with caution, right? We want to make sure that banks aren't excluding certain areas of where they do business at the cost of other areas. And so if this is adopted, we would really want it to be focused on areas like rural areas or areas with historic disinvestment to make sure that we're getting the most bang for the CRA kind of buck. So that's where the other areas for eligible community development activity comes in. And then finally, the thing that is not included in the NPR, but we strongly support, is the creation of deposit-based assessment areas. And this is where a bank is receiving deposits from a community. And so we think that this would account for new ways of banking. People are doing a lot of online banking these days. And the CRA should evaluate how banks are doing, like how they're doing from a community reinvestment perspective, where they're actually doing business, right? Which includes getting deposits. So this is something that we've included in our letter as something that we strongly support. And then next slide, please. And just we want to mention rural communities. Being a statewide organization, we know that there are many areas in Illinois where there's a lack of investment. And one of the things that we think is a very good news is that the regulators include consideration of rural areas and the unique credit and banking needs kind of throughout the NPR. And we kind of support doing that, right? We think that rural communities have unique credit and banking needs. And ways in which we would support that is, for example, the other areas of eligible community development and activity, if it can be really focused on kind of looking at rural communities and other historically disinvested areas, that would be a way in which we would support that assessment area. And then also in terms of impact review, Jane mentioned that, and we think that like rural communities could fall within an kind of the impact review, and if something is very significant because there hasn't been a lot of investment. So I would encourage, we're gonna, in our comment portal, which you'll hear about later, we're gonna have a paragraph around rural communities, but if you have specific experience that you wanna raise to the regulators around rural community banking and credit needs, I would really encourage you to go ahead and add that in our comment portal. So with that, I will pass it on. I believe it's to Horacio.
Hello again, everybody. It's always good to unmute. You'd figure after 2 years of COVID, we would remember to mute and unmute. But this touches back to, I think, a comment that Chris Brown made about community engagement. And the agencies are asking for ideas to a certain degree. They didn't really propose a whole lot new with regard to how the community is engaged. But given how we all feel about grade inflation, and the fact that not all examination teams are created equal in terms of how high a bar they set for appropriate financial institution performance, we felt it was important for us to make a few strong statements about community engagement. The first and foremost is there are a number of regional and national distribution networks, be it through trade association, nonprofit advocacy organizations, everything from NCRC to the Illinois CRA Coalition. We all have great and strong distribution lists, and it is not unusual for the agencies to advertise their events, their conferences, et cetera, using some of those distribution networks. So it's not out of the norm, and it's not too much work for them to also leverage those networks to be able to give everybody a quarterly heads up about upcoming CRA exams that that network or that geography should know about. So that is one piece, just to sort of raise the flag, like, okay, great, here's some information. But now what do you do with that information? First and foremost, one of the things that we'd like to propose is a simple link within those announcements to be able to allow organizations and individuals a couple of different options. First and foremost, to be able to allow somebody to submit a comment virtually. Seems pretty basic. You do that on Yelp, sometimes honestly, and sometimes to bribe the restaurant, depending on what's going on. But for the most part, that's pretty common these days to be able to provide comments. So I think the agencies probably wouldn't be, busting down any doors in terms of innovation to be able to do so. But the other one would be to create a database for organizations, individuals, et cetera, that want to be contacted when agencies are evaluating a financial institution in their geography. Now, the great thing is about using networks to get the word out would be you may want to comment on an institution that you have a product with that may not be physically present in your community. So that's kind of ties in with that retail lending assessment piece. You may have a good or a great opportunity to be able to provide feedback on product, services, affordability, or an impact on an institution where you have a virtual relationship with. So it doesn't always have to connect with that physical branch network. A third piece, obviously, above and beyond being able to provide comments and then the agencies reaching out to a database of people that say, I want to be engaged in this process, would be to make sure that examination teams actually conduct community contacts de novo, like new, refresh for every exam. Corners are cut often to be able to use community contact information from a previous exam somewhere nearby, and other ways to be able to actually not step out of the bank office and meet people in the community and ask them questions. So we just want to reaffirm something that's been in the CRA for a while, but has not always been held to the high standard that for every CRA exam, we expect the examiners to go out and have new community contacts to talk specifically about what's going on in the community, the role of financial institutions within that community, and also to be responsive to those who have said that they want to be contacted about those questions. Last but certainly not least, we want to make sure that not just with regard to engagement in the community and asking questions, but also with regard to the performance evaluations, the public portions of the CRA exam, how information is provided and how much transparency there is about what the examiners used in making their determination. In order for us as interested and vested stakeholders in the success of the CRA, we want to be able to make sure that we understand what's written. And sometimes that may not necessarily come forth in some of these exam findings. It's wonkish, or it may not include a lot of information that was considered. So we just want to make sure that plain language is used in the notifications of exams, in the actual exams, the performance evaluations, any requests for information, and some of the outreach that they do in the community to be able to make sure that the process is as democratic as possible. With that, let's move to the next slide. Overall, though, as I had said at the beginning of the my initial comments, was that idea of the regulatory burden budget. There are a few pieces that we need to stand firm on. I think it is pretty clear from what Sharon and Jane have said that under no scenario do we think it's acceptable for a financial institution or a group of financial institutions to have less obligations in community reinvestment as a result of this reform. We just have to draw the line. So that is first and foremost our starting point for this. Now, while we understand that there can be a burden associated with more data that is provided both for the exam and then also publicly available, there is a direct correlation between transparency and accountability. And we need to make sure that any future potential for great inflation or lowering the bar for passing CRA exams at a satisfactory or an outstanding rating can be verified on our own part as justified or not. And the only way we're going to do that is by having more data available for us to do our own assessments and to study. It's something Woodstock does a lot of, NCRC does it, a variety of different other organizations need more data to be able to understand exactly at what standard and how efficiently this process is working. Now, while there may be a regulatory burden associated with that on financial institutions, we would need to turn on that part of our brain that cares. Because it is certainly well within the resources and the financial capacity of financial institutions to be able to provide some more data. It is not within the resources and capacity of low and moderate income communities and communities of color to see their institutions do less and not have the data to be able to prove it. So when you balance those two things out, I think, yeah, you probably don't want to drown financial institutions to a point where they just basically throw their hands up and stop doing things. But at the same time, the balance of interest needs to be in the communities that the CRA is chartered to serve, not necessarily for the interest of financial institutions to reduce as much of their regulatory burden as possible. And last, what we already talked about, let's just make it in plain English so everybody can understand what the heck these people are talking about. And then we can have an honest conversation about whether or not we agree. And if so, great. And if not, how and why. So I will hand things back now. Next slide. Oh, no, I'm still talking about balance of interest. I apologize. I forgot about that. One of the things that we've talked about is the inclusion of direct and indirect consumer loans in the retail lending test. As of right now, the regulatory agencies really are kind of, for some reason or other, focused on auto lending, and that's direct auto lending. And while financial institutions do have a pretty good chunk, somewhere in about like 1 out of every 5 auto loans goes through a financial institution, it's not necessarily intuitive that that's exactly where people go to get their auto financing. In our work on predatory lending, we've had a talk with a lot of financial institutions that have said, we don't make any high-cost auto loans, only to find out later on that their treasury departments are actually investing in asset-backed securities with high-cost auto loans. So while they may not necessarily be originating predatory auto loans, they're investing in them. So we certainly want a situation where both the direct lending as well as the indirect, either partnering with a non-bank that's doing this product or investing in securities that are providing liquidity to bad actors, that needs to be reviewed. And as we all know, that's not limited to auto. That includes consumer lending. You've got players like OppFi and others that are using financial institutions' charters to be able to lend at rates that violate state usury laws, and even to a certain degree, some consumer financial protection laws. We feel that that needs to be taken into consideration, and we need data to be able to prove that they're either not using their charter for non-bank actors to do bad things in communities we care about, or to be able to pat them on the back if they're using non-bank actors to be able to provide flexible and responsive products that banks themselves aren't necessarily having the capacity to be able to do. So it's both plus and a minus on that. There's a proposal in this rule to be able to see whether or not financial literacy overall should count, irrespective of whether or not it's targeted to low and moderate income communities. We think that's a stupid idea. Let's just keep things the way they are and focus it on the people that really need it. I cannot see, feeling good about the fact of having some high net worth luncheon when they're talking about retirement programs for people with millions of dollars counting as CRA related activities. That's just not within the realm of our reality. There's also a proposal to be able to talk about how financial institutions, when you aggregate their performance from a number of different communities, how do you weigh that and how do you build it up to an overarching rating? And as of right now, what the agencies are asking us about is, are you okay if, for the most part, they are performing at a satisfactory or higher level in 6 out of every 10 communities, 60% of their assessment areas? That is a whiskey tango foxtrot moment right there. It's basically the agency saying, you can fail 4 out of every 10 communities you serve, and you'll still do okay. I mean, I don't need a poll to like, are you guys okay with that? Actually, in Woodstock's comment letter we're working on, which is becoming by the hour more and more snarky, I said I would agree with that if the agencies would go to the mayor and the communities that are failed and say, this is why we're okay with that. It's just not plausible. So we don't feel any institution should be able to fail any of their communities and get a satisfactory rating. Tied to that, with regard to the weighting of products, we feel that sometimes the way that things are set up, the larger deals get a lot more attention than some of the smaller deals that are critical in the communities that we care about. This includes consumer loans, which may be $500, $700, $1,000 loans. So as such, when the regulatory agencies are evaluating performance, we feel that it's important to evaluate the products based on the number of loans, not always on the dollar amount. So that way you have an idea about how much small dollar lending, how much of the smaller sized community development deals are being done, not necessarily whether or not they're going elephant hunting and getting the $150 million massive multifamily affordable housing deal. That, while important in communities, may not necessarily have the same kind of impact as some of the smaller, more complicated and more needed products that may exist out there. Financial institutions that are above $10 billion are being asked to be able to collect deposit information so that there can be that connection between deposits and where the financial institution is doing its CRA activity. This is a step towards the creation of deposit-based assessment areas, which we think makes a lot more sense than taking a look to see how banks are lending in places where they're already lending. The CRA is about the connection between taking deposits and then reinvesting those back into the communities where they're getting them from. So this ties to the very first bullet point, treating all large banks equally. Initially, back in the mid-90s, we started with small banks and large banks. And then somebody got the idea of, well, what about like smarge banks? Those ones that are kind of large, but they're on the smaller side of large. So then they created what was called intermediate small banks. And not really sure that changed a whole lot or did a lot of good in the communities that CRA is targeting. But now they're adding another layer, which is, oh, in large banks, you have those above $10 billion and those below $10 billion. This is too much. This is turning the CRA into the tax code. And for the most part, we feel that everything that this proposal is asking banks above $10 billion to do, pretty much all large banks have the capacity to do that. So let's just treat all large banks equally and not divide them up. And then it's a broken record, but we have to hammer it away. No institution should do less because of this reform. All right, now I'm ready to hand things over to Tasha Brown from Small Business Majority. Thank you.
Thank you. Good morning, everyone. So Small Business Majority has reviewed the proposal, and there are several things that we're asking to be included in the proposal in the final regulation. And so there are three that I'm going to have listed on the next slide, on this slide, excuse me. But there are others that we're also discussing. So the first thing we want to be included is for the regulation to really spell out that there will be the leveraging of Section 1071 of the Dodd-Frank Act, which required financial institutions to compile and to maintain and submit information about race. And so we want them to leverage that data to better track the success of lending to BIPOC small business owners. And so, as everyone has already stated and reinforced, the CRA was simply about bringing some racial equity. And so we want to make sure that race is acknowledged in the lending that happens for BIPOC small business owners. Second to that, we want to ensure that the small business component of the retail lending test accurately measures and tests all business lending made to smaller firms, especially for loans under $250,000. And not just the loans that are made, but we're also looking at lines of credit. We also want them to acknowledge credit cards. And so there are different loan products that are available for small business owners, but they're not often extended to them. And the third is to ensure that credit products are offered responsibly and sustainably to small business owners, including by examination of annual percentage rate. And so I think it was said a little earlier, but it's important that we are not, that we're saying to them, we want you to make sure that small business owners are not given debt that is going to cause more harm than good. We don't want them to not serve the community. And so we don't want expensive loan products offered that don't serve the needs of the small business owners. So we're asking that that is included in the proposal. Some other things, additionally, other things that we are looking at and we want to submit for comment, or submit for our response for their comments, includes the consideration that business owners, the community development piece that they're looking for, the community development test, that we're looking at different activities that the bank will be evaluated on the different activities that are through the community development. So to give you an example, we don't want them to take away the opportunity for banks to, I'm lost in my notes, I'm sorry. We don't want them to take advantage of the opportunity, or take away the opportunity for banks to successfully test how adequately they are lending to the community. So we want that to maintain. Additionally to that, we want the data collection to also not change during the transition. And so one of the things that was proposed is that there will be this stopgap during the transition where they won't be tracking this information. And so we're looking for them to not stop that, but to continue to track the information about how banks are lending during the transition period, because we all know that that stuff can fall through the cracks. So in addition to the 3 here, we are looking at the other items and we're answering their questions about other ways that small business owners can benefit from a re-evaluation of the Act. So those are the top 3 that we wanted to share for the small business community. And I'm going to turn it back over to,
That would be me.
is that Horacio?
That is,
Yes.
I'm back. And guess what? Now we're going to talk about race, and it's a broken record, race and the CRA. So the advance notice of proposed rulemaking, so that was the last time we went through this process with a bunch of webinars. We had some really robust and very good conversations of the issue of considering race in the CRA, because the Federal Reserve asked a lot of questions about it. Not only that, a big chunk of the very beginning of the advance notice of proposed rulemaking was talking about the relationship between race and the CRA. So given that, it is incredibly disappointing that this issue wasn't addressed in this version of the proposed rule. It's like, you know, they did this massive never mind and just moved on. So with this in mind, we're reiterating that race should be explicitly addressed in the CRA and incorporated into exams. Now, CRA was implemented to address the practice of redlining and racialized patterns of disinvestment in low and moderate income communities and communities of color. So redlining was enforced by assigning areas as high risk based on race, not income. So with the regulatory structure that is focused on income, the CRA does not sufficiently address the racial disparities that the law was meant to address. So if the CRA is going to function as an effective tool to address ongoing barriers, it has to address race directly. Now, in the notice of proposed rulemaking, the agencies proposed the following. They're going to publish Home Mortgage Disclosure Act data in large banks' CRA evaluations, so their performance evaluation that's publicly available. But the findings of any analysis associated with Home Mortgage Disclosure Act data, and at some point, hopefully the Section 1071 data as well, that's going to have similar information surrounding small business lending that was just talked about. The findings of that analysis of that data will not have any direct impact on the rating, on the CRA rating. So there you have it. That's about as disappointing as things can get. So let's move to the next slide. Race should be affirmatively considered when measuring CRA performance within the proposed new evaluation and testing framework. That's just a starting point that we just believe is reasonable. So we have 5 recommendations on that. That is in the sign-on letter and will also be the basis for Woodstock's comments as well. And I know I took some of this stuff from NHS's comments and the Opportunity Finance Network and other advocacy organizations. We all feel the same way. First and foremost, adding racial demographics to the list of factors that are considered when determining what a community is for performance of CRA is not new. That used to be one of the assessment factors in the very first version of the implementing regulation of this law. So can we go back to that? You know, it seems like at the time that wasn't that big of a deal, but now it seems like we keep moving backwards. So why don't we just bring back what we had a long time ago that actually admitted that race should be considered when a financial institution determines the definition of the communities it is chartered to serve. So secondly, I think creating benchmarks and metrics to actually evaluate the provision of financial products and services should be included in each subtest in a manner that's racialized. So it shouldn't just be taking a look at how a financial institution is providing these products on an income base, but it needs to be marrying that fair lending piece of it to that as well, which is how is that distribution, the accessibility, and all the other factors associated with it doing when you actually filter it through a racial lens. HMDA data already does that, so incorporating it, but not using it to me makes no sense. And that's the case for all of us here on the steering committee, as well as I think as a coalition. So if you're going to include it, use it. It's not a sticker that doesn't make sense here. Yeah, so let's just go ahead and incorporate it in a useful manner. The last two are things that we mentioned in our previous letter to the Federal Reserve for the advance notice of proposed rulemaking. First and foremost, any violation of consumer protection laws, civil rights, equal protection, you name it, should create a situation where that financial institution is immediately downgraded in its CRA rating to needs to improve. You simply cannot violate civil rights, equal protection, or consumer protection laws and still do well under the CRA exam. And it shouldn't matter whether or not the financial institution did it 10 years ago and just got busted, or whether or not they cut a check and found their way out of court. At the end of the day, if there is the evidence that they violated these laws, they should not get a good CRA rating, period. Now, there are some cases where those exams and those findings take a while to figure out. So if a fair lending investigation is pending or any other type of investigation that touches into the area of civil rights and consumer protection, the examiner should note that during the exam. And then once that investigation is done and concluded, a follow-up should be done to either change the rating or keep it as it is, depending on how that investigation is finalized. So these are our 5 proposals, our 5 recommendations that we'll be adding onto the sign-on letter as it regards to race. Now, there's a reason why we put this last, because this was actually the area where we had the most conversation in the past. So if we move to the next slide, this is where we're going to open things up for comments, not only about the information that we already provided, Sharon and Tasha and Jane and I, but also with regard to things that we didn't, whether or not there are priorities that you have that may not have found their way to our priority list, and whether or not we need to have a conversation about what you think will help your community in meeting credit needs and how these rules should represent that. So at this point, I'm going to open it up to anyone in the group that may have questions, comments, additions, or deletions.
You're welcome to take yourself off of mute, but I'm also happy. I noticed Callie had a really interesting and I think important comment and question in the chat around people with disabilities in LMI communities. And I know, I think that I am not sure what data is tracked in that regard, but I do think adding to our comment letter that in addition to plain language, it also has to be accessible to people with disabilities and available in different formats is a really great suggestion. And I think, so we will add that to our letter. But I don't know, Horacio, Jane, or Tasha, do you know if there's like any specific data that is tracked in terms of people with disabilities in LMI communities from a CRA bank exam perspective?
It is a factor in assessing the accessibility of products, services, as well as physical facilities. But I don't think to the degree that Kelly is suggesting, and I think that's a wonderful addition.
Mm-hmm. And Callie, please feel free to come off of mute. I didn't want to speak for you, but I thought, I know some people, it's harder in a Zoom context sometimes.
It also might be a good thing for us to call out for the impact review as well, adding that as a potential factor for the impact review.
Mm-hmm.
All right.
Thank you.
Sharon, you did a good job. Anybody else?
Well,
So there's a lot more depth and a lot more categories to this area. And I'm not, has anybody, it's like, just raise your hand if you have. Has anyone actually read the whole thing, aside from the poor people that presented that had to? There are no gluttons for punishment here.
Well, I just want to echo something that Chris had said earlier around community engagement. I mean, I think we spend a lot of time on that because one of the things that's most frustrating, I think, is that CRA was a tool that arose from community organizing in Chicago, but also nationally. And it was really meant to help individuals and communities, right? You know, it had a remedial purpose. And yet it's become so technical and so complicated and like 700 pages. So we do start our comment letter saying, you know, kind of just even, we appreciate them wanting to get comment and specific feedback, but even the format itself is a barrier to community engagement and community participation. And so I just really want to echo that I feel very strongly, we feel very strongly as coalition that we have to make this accessible to people, because otherwise, you know, it's not going to be as helpful as it could be and should be and needs to be. And Damar, have we engaged LGBTQ plus organizations on this? We will in the sense of if on our distribution lists, but we have not, at least I have not specifically done outreach or engagement on that. And I don't know if anyone else has. So I think that's a great reminder and suggestion. I don't know if anyone else has anything else they'd like to say.
Thanks for that, Dominic. Look, at the very least, with regard to the information that Jane provided, and I apologize because I actually was typing a note and I shifted my binder and it hit send before I was ready to. So there was a list of 6 financial institutions. Just in Chicago alone, there is a mapping system that NCRC, the National Community Reinvestment Coalition, created to be able to understand the impact that changing the size thresholds and the different levels of compliance with CRA will mean in certain communities. And we can send out a link to that either in the chat or in a separate email for you to be able to look at your community. But just out of curiosity, when we looked at Chicago, there were 6 kind of smarge banks. First Eagle, Gold Coast, Hoyne Savings Bank, First Nations Bank, Community Savings Bank, and Devon Bank. They're all based in Chicago. They add up to assets of about $3 billion. And this proposal would eliminate their requirement to invest in CDFIs. It would eliminate their requirement to finance multifamily affordable housing. So those are the type of community development finance activities that make or break communities. And even if you're talking about a small fraction of their asset size being dedicated to this kind of communities or those kind of activities, that ends up being hundreds of millions of dollars a year. So this matters tangibly with regard to a simple thing like, let's just change the dollar sign of financial institutions when we examine them. That's not okay, especially if it creates a situation where the financial institution is doing less and its community gets less. So when we have information out on the portal that Sharon and James are going to be talking about, keep that in mind. You don't need to dig deep into the policy wonkish areas that we talk about with regard to assessment areas or a lot of the other issues we raised on the tests and the subtests. Focus on the potential negative impact and feel free to use plain English and not banking language or policy language to be able to make your pleasure or your displeasure heard. Now, while that's the case with regard to some unintended consequences, I do want to share that from the conversations we've had at the steering committee meetings, we like the fact that the retail lending test sets a higher bar of performance for financial institutions. This is a good thing. By our analysis and the analysis of others, very few really large financial institutions will get an outstanding rating based upon the proposed structure of the retail lending test. And 10% of financial institutions would fail. So that's raising the bar. So I don't want to give the impression, and I don't think Sharon does either, that all of this should be thrown out. Some of it is actually really good. But what we're presenting through this webinar is, okay, what do we need to make sure we're able to comment on that may do inadvertent harm to the communities and the individuals that we want to help? I'm not sure, Sharon, if you want to add to that.
No, other than, I echo, out of the 700 pages, there's a lot of good, right? We just wanted to highlight the main topics that we thought were important based on the work that we have done over the last 3+ years, talking to different community members, and then the analysis that we're currently doing. And I wanted us, and maybe Horacio, you can answer this, but Christy asks, like, is outreach being done to the financial institutions that may want to help, or suggestions on investment? So that, I think that the answer is kind of informally. I've had conversations, but I think that, the industry, the financial institution industry has their own kind of position. So what we may hear from an individual CRA officer or an individual banker may not actually end up being reflected in the official statement from that particular bank. But Horacio, do you want to?
Yeah, we've had conversations, unofficial conversations with a number of large financial institutions, just to sort of get a sense of what their highest priorities are. So that way we could see where we're aligned and where we diverge. Because we're also talking to politicians about this potential impact as well. As a matter of fact, we're having a webinar in a couple of days with a lot of our elected officials about this. And we've been surprised at how much in alignment they are with some of our concerns. The potential negative ramifications of the dollar amount threshold for retail lending to make the decision of cutting off credit in a lot of communities where we can't afford to actually comply at the full suite of CRA in communities where we don't have facilities or where we don't have staff. That's one unintended consequence. The others are, even financial institutions talking about the fact that, wow, they're gonna give us an option on all of these different exam procedures. That doesn't really seem to make sense. And while that may benefit the banks, it's especially if the idea of this exam is to raise the bar for performance. I can't imagine, like in the example of a small bank, if they have a chance to kind of skirt by on the small bank exam that they've been living off of, which really requires very little, or they have the option of being elevated to that retail lending test, it's harder to pass. I mean, whatever small bank is going to go ahead and option to go up to that is going to both get the Presidential Medal of Freedom, and they'll probably get kicked out of their bank trade association. Mm-hmm. So, that just doesn't make sense. And even financial institutions are telling us that. So we are actually much more in alignment than we realized in a lot of these key issues.
Yeah. So I want to kind of move us forward, because one of the other things Christy mentioned is that, like, this is really complicated stuff. And, it is one of our main goals is to make it accessible and make it so that people can actually comment on this really important rule change. So if we can go to the next slide. And I don't want to cut off questions, but I also want to be mindful of time. Oops, maybe we can go to the next slide, but okay, here we go. So there's a couple different ways that we're trying to make it easy for community groups and individuals to comment on this important rule change. We are going to have a sign-on letter that we've been talking about throughout. It's in its draft stage, and we're going to be reviewing it with the CRA Coalition Steering Committee on Wednesday. But we will then be sending it out to a link if you want to sign on to it via kind of, if you registered for this webinar, as well as other networks. So that'll be going out this Friday. And the firm deadline, though, for us to get your sign-on, your approval, would be August 4th at noon. And I want to be careful about not confusing people with deadlines. So link will be going out on Friday, but we need to hear back from you if you want to sign on to the official coalition sign-on letter by August 4th at noon. We also have this portal that we mentioned, this comment portal that Housing Action uses for our advocacy campaigns. And in it, there'll be some basic language as well as some specific paragraphs on different topics like rural issues, CDFIs, home ownership, wanting to be contacted if a community organization database is created for future exams. That portal, the link for that portal will also go out on July 29th. And if you're going to use the portal, you have until the official deadline for all comments, which is this Friday, August 5th. There's no time deadline, so I imagine, midnight. And we will also put all of this information on our coalition website, which again is IL CRA Coalition.org. Yeah, next Friday. Did I say it was this Friday? I meant next. So links will go out this Friday. Comment deadline is next Friday, August 5th. So just to be clear. And just to note that if you do submit it through the comment portal, or if you send your own letter, because you can write your own letter, your own comments, and send it directly to the regulators. And the way to do that is in the notice of proposed rulemaking. There's a link on our website, on the Illinois Coalition website, to the full 700-page notice of proposed rulemaking. And the instructions on how to comment are at the very beginning. But note that all comments are public. So if you send it, be thoughtful if you're going to include personal information, right? Because it does become public on a national level. So that is that. And again, we encourage you, if you have additional feedback or comments, to just let us know. But did I get the deadlines and how you can comment in the various ways? Is that hopefully more plain language and clearer than the actual NPR, but I'm not 100% sure about that. So, and yeah, once the coalition letter is ready to go, feel free to use parts of that if you would like. So now I think we're going to wrap up and go back to Jane.
Yeah, so one last item that we want to make you all aware of. The Illinois has its own state level CRA, which, I mean, in a lot of the ways that this federal proposal has been disappointing, the state CRA is really exciting, and we have a real opportunity to make an impact there. So this is something to keep an eye out for. It's on the horizon. This law passed last year and was signed into law last year in March of 2021. And with this law, Illinois became the second state with an oversight system to ensure that residents are equitably served by all three major segments of the mortgage lending market. The federal CRA only covers banks, but the Illinois CRA covers state chartered banks, state chartered credit unions, and state licensed mortgage companies. So it's exciting that way. And it's also exciting to try to get it to incorporate race more proactively. So we're expecting another comment period from the state regulator sometime soon. We don't know exactly. They did an advance notice of proposed rulemaking end of last year. So there will be a notice of proposed rulemaking at the state level where we'll have another chance to comment, and we'll be doing more outreach to you all when that happens.
Thank you. And Phyllis asked about the PowerPoint. Yes, we will send out a PDF version of the PowerPoint to everyone who registered for the this webinar, as well as it will be on the CRA Coalition webpage as well under resources. So I want to thank everyone for joining us. I think that was our last slide. Okay, yes, I will make a note of that, Dominic. And everyone, if you'd like to reach out, feel free to, our emails were at the very first slide. I felt like maybe we should have put our emails again at this back slide, but you can also reach us through the IllinoisCoalition.org. I think there is a contact if you send it an email that we'll get it at Housing Action and forward it on appropriately. But thank you. I want to thank all of the presenters. I want to also thank James and Bibian from Housing Action, helping us kind of with this webinar, as well as James for his work on evaluating the NPR. So looking forward to getting sign-ons and comments. We want to have a great presence from Illinois because this is really important to our communities. We've worked hard. And so thank you. Thank you for participating because we appreciate your show of support as well.
And in the tradition of Illinois politics, vote early and vote often, comment, comment as many times as you want.
So, all right. Thank you, everyone.